This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors. So I feel like it's time to take a look at some top value stocks for this week because we haven't in a couple of weeks, and we mostly through earnings season, but not completely, but mostly through it. And that's when the Zacks rank changes quite a bit. And it'll be interesting to see here in 2024, as we're starting March, where are the value stocks, right? Because this rally that started late last year, in the fall of last year, really has continued here in 2024. And none of us are complaining about it, but stocks have gotten pretty pricey in certain industries like technology. And so it's become a little more difficult to find value stocks, but they are still out there. So I'm not complaining completely, but they're mainly in areas none of us want to buy in, right? A lot of in energy. Some of the banks are cheap still. Some of the retailers, but we may or may not want to be in those. So it is kind of, as would be par for the course for value stocks, in the rejected areas. Because, of course, remember, value means that the street is ignoring it for whatever reason. And some of that reason might be because, hey, I don't want to own these energy stocks, or, oh, the banks, that's too risky, so I'm staying out of that. And other reasons might just be it's a smaller cap company that nobody's really heard of, and they're not in, AI or the data centers in some way, so they haven't come across anybody's screens. It could be, again, retail that's been out of favor for a while, but seems to be kind of coming back. Is it just me? No, there's several well-known retailers who have been down on their luck for many years, suddenly surging. I'm thinking about Abercrombie and Fitch as one of them. That's ticker ANF. If you want to go check out that chart, I encourage it because it's gone vertical, as they like to say. And so if you were a long-suffering shareholder in Abercrombie, you are taking a victory lap right now. But it's just been really hard to own a lot of the retailers because they have underperformed. They're still kind of the key big brands like Lulu and Ulta, and some of those that, consistently over the years have held up. But anybody in the apparel side, it's been real tough to be a long-term investor. And I'm thinking in like VF Corp or PVH or G3 Apparel. Those have been tough investments. But as well as the niche retailers like Abercrombie up until recently, or Express, or one that I'm going to talk about today, or even some of the furniture retailers, those have been down on their luck a couple of years now after surging during the pandemic. So this looking around for value is what I want to do this week. And I decided to run a simple screen I've run before because we just finished earnings season mostly. And it's looking for Zacks number one ranks, and they need to be cheap. So that's about it. It's pretty simple. Some of the other components, the average volume has to be over 100,000. So we're not getting the super small, tiny traded stocks. It has to be over $5. Again, also so that we don't get, stocks that are 50 cents or anything like that. Price to sales has to be under 1. So it is using the price to sales ratio. And remember, under 1 is the value price to sales ratio. And that means, say, if it's 0.7, it means we're only paying 70 cents for every dollar of sales. So that's on sale. The sales are on sale because we're only paying 70 cents for every dollar that company's generating. PE, this does include the PE, and it's under 20 here. But most of them are even a little cheaper than that. I'm looking down my list. Most are a bit cheaper than 20 or 19 or so. But Still, it is a little bit higher than my usual 15 or under, just because we want to get a little bit more of a choice on the companies here. So we looked for it with a little bit higher. Now, this is kind of a narrow screen because of the Zacks number one rank. Remember, number ones are the strong buys. It is the top rank, and it means that there's usually only about 210 to 250, give or take, somewhere in that range. And if it's closer to 250, that's on the high side usually. I saw it at 244 last week, so it has been on the high side, but we are finishing up earnings season, so it's going to be a little more bullish maybe. I guess that's a good thing too, if we are seeing it a little more on the high side. So more stocks are getting the Zacks number one rank, and that's positive, because what does it mean? It means, as a strong buy, that the analysts are raising their earnings estimates. So we're getting something good there if they've decided to raise it, and that doesn't necessarily mean there's earnings growth. So I always keep that in mind. I think people get it kind of confused, but it means that at least one analyst, but hopefully more than that, are all in there raising because they either surprise maybe on earnings, they raise their guidance, something like that is most likely going on. So you can find where all that is located if you're in, sorry, I'm suddenly losing my voice there for a moment. You can find it on the detailed earnings estimates link on the side in the gray area if you're on Zacks.com and you put in a quote. So go away from the homepage, put in a quote and, some ticker up in the quote bar, and it should give you just the regular quote page for that company. And then it will show you that grayish box on the side that will be where you can find a whole bunch of links, and it has one for detailed estimates over there. So be sure to look there. If that makes any sense. Yeah, so there's a lot of information on the Zacks website, and it is always good to go over and consult it once you run one of these screens. This is one of the preferred screens. If you are a Zacks Premium, you can access this on our screening page, and I like to use it. But for those of you just listening in who aren't the premium members, you can get this information from me. And so you're getting a little bit of, inside insight that is free. So I love that on the podcast. Okay, so I ran the screen. It has about 5 components to it, and I got 37 companies. Now I have to say that was more than I thought. I did not foresee that. I thought maybe 20, but 37 is a lot. But we just did finish earnings season. And apparently there's some more value than what I knew was going on out there. So that's promising, because it does feel like a lot of things are overvalued here in 2024 as this rally continues on. And some of these stocks are trading at sky high valuations. So what's in here? So there are retailers. There are a few energy companies. I brought some of those. There's some restaurants and some other consumer names. There's some housing type of related, but I didn't think I saw the home builders. So they weren't really in it this time. But it's some of our usual suspects that have been valued for a while, including the auto manufacturers. So GM was on there again, and Honda. We've talked about them recently. So I'm not going to cover them this time. I tried to pick a few names that were a little different, that maybe we haven't talked about in a while, but that now have the good Zacks rank. So let's dive into the 5 companies that I picked out. And I came up to a snafu on the last one, which I was like, whoops. So I'll tell you what that is when we get there. Okay, so the first one is American Eagle, ticker AEO. It's been on the podcast many times. It is a niche retailer. It owns both American Eagle and the Aerie brand, which is like the lingerie slash, pajamas, stuff like that. And Aerie, very competitive with like Victoria's Secret and the other lingerie brands. And that was a big driver of their growth for many years. I feel like it's kind of calmed down a bit now, though. It's kind of over a little bit, but we're going to find out because they're reporting earnings on March 7th. And by the time this podcast comes out, they will have already reported. So some of this data is going to change after this earnings report, but I am pretty bullish on these retailers in general because we have had earnings on many of them, and this is all for the holiday season still. That's what they're reporting, but they are reporting not only was that good, we already know that the holiday season was very, very good for most of these retailers, but their guidance here for fiscal 2025 is what they're going into, that this year they are still bullish and that the consumer continues to spend. Now, it has always been iffy on the apparel side, which American Eagle has a lot of. It does have some accessories and things like that too, but it's apparel, and that always kind of goes in these weird trends and things like jeans are in and then they're not. Then athletic wear is in, then it's not. Then I don't know, vests are in, then they're not. So it's very difficult for these retailers to get the trend right and then to stay on that trend. Now, for many reasons, Abercrombie and Fitch, which is, I would say, a competitor of American Eagle to some extent, with the same similar type of customer. American Eagle has been taking Abercrombie's customer for a number of years, and now possibly Abercrombie has taken that back. So that's something to watch in this earnings report. But again, they do have Aerie, which is a strong lingerie brand as well. So how cheap are they? PE of 15.6, price to sales is 0.9. Both of those obviously in the ranges that we searched for. They have a 4.6 billion market cap. They are in 80 countries. They do ship around, and they have franchises that own in like Canada, Mexico, and I'm not sure if they're in Europe. They may be. And so they're a little bit more out there than just the United States. Dividend yielding 2.1% here, so that's not bad. They've always paid a pretty nice dividend. Now, here's where it gets a little bit touchy. Over the last year, the shares are up 71.5% because a lot of these retail stocks have really caught a bid for the first time in a long time. They were always just kind of, would have like mini rallies a couple of years after the pandemic hit, and nobody needed certain types of clothes during the pandemic, so they struggled with that. They struggled if they were in the malls, which were mostly shut down. They all have online now, though, so that helped them get through it. But now we're seeing an actual pickup that's not related to the pandemic in these businesses now. Maybe we're all just tired of our clothes. We need something new. So, and we have some extra money to spend. So that's American Eagle, ticker AEO, and we'll see what they say on this next earnings report. Okay, the second company is American Woodmark. This is one you might not have heard of. Its ticker A as in Adam, M as in Mary, W as in Wendy, and D as in David. AMWD. And their tagline is a family of cabinet brands. So if you're putting new cabinets in your kitchen, you may be buying them from American Woodmark. I think they have some direct sales, but a lot of it is through distributors and through the big boxes like Home Depot and Lowe's. Now, this kind of went out of favor, right? When home sales declined or we were done remodeling our kitchens during the pandemic, then, their sales declined because, we're pulling back on those home renovations, and kitchens were a big part of it, but we haven't completely pulled back. And there is no recession right now in 2024. And so the consumer, again, is still mostly spending on their homes still. And so I'm taking a look at, fiscal 2024 on American Woodmark, they are expecting sales to decline 13.4%. That's what I would expect versus the prior year as home sales have slowed, and new home sales have come down about 30%. So if they're putting the cabinets in all those new, Toll Brothers or Lennar or Pulte homes, they're putting in less right now. Next fiscal year expected to be up 2.9%. So a little bit of an improvement next year. And they report earnings again in late May. But we do have one analyst raising the estimates on this one for this year and next year. That's how we get the Zacks #1 rank. It is a small cap, so it's not highly covered. We only have a couple of estimates, and it has a market cap of just $1.5 billion. They don't pay a dividend. They are cheaper than American Eagle, PE of just 10.7, price to sales of 0.8. Over the last year, the shares are up 62.5%, but the 5-year record, and that includes the pandemic, is just up 18.7%. The S&P 500 is up 86% in that 5-year period now. So this is definitely one where you kind of have to time the bottom. And now we're up 62.5% in the last year. So we're not really at the bottom, right? If you go look at the chart, you'll see it's up, it's down, it's up, it's down. It never really breaks out and continues up, at least in the last 5 years. It's still cheap, but I do feel like not enough people really know American Woodmark for these shares to really bust out much. I used to own it in the value investor portfolio, but we had to sell and get out because it's just so lightly followed and not many people are interested. So we did have to get out. But again, it has a Zacks #1 rank, and it is still cheap even after this big run up. So that's American Woodmark, ticker AMWD. Then I'm switching over to energy with Sunoco, ticker SUN. Sun is their ticker. They are an MLP. And remember, that has specific tax implications. So master limited partnership, they have to pay out to their unit holders, is what they call them. It's the same thing as a shareholder mostly. They have to pay out a certain percentage back to you if you own this. So a lot of people looking for dividends like to own the MLPs. They distribute fuel to convenience stores, independent dealers, distributors in 40 states and 10,000 sites. So when you go to fill up at that convenience store, Sunoco might have been the one putting the gas there. It is trading at a new 52-week high. And over the last year, it's up 42%. That's pretty bullish. I wasn't expecting to see it at a new 52-week high because I am used to the other energy type stocks being, kind of down on their luck and, weak right here. But the MLPs, again, people like the dividend. And this one is yielding 5.4% right now. So that wasn't a bad trade. You're getting 5.4%. And if you've held over the last year, the shares are up 42%. Not shabby at all. PE is 14.3, price to sales is just 0.3. So that's Sunoco, ticker SUN. Then we're staying kind of on the consumer side, but on the food and beverages with Molson Coors, ticker TAP. T as in Tom, A as in Adam, P as in Paul, TAP. And they're, of course, cheap. PE is just 11. Price to sales ratio just makes it for this screen. It's at 0.98. So right there at the 1 mark, but we'll take it. We're still getting a little discount on the sales side of things on this one at 0.98. Not as cheap as some of the others, but still fits in the parameters. I actually wouldn't mind even if I was getting one, if I was buying the sales at what they we're making. But of course, if we can get it even cheaper than that, the better. Sales expected to be up 1.3% in 2024 and only 0.96 in 2025. And earnings growth, single digits at 4% for 2024 and 5.4% for 2025. Estimates are all higher, so people are a little bit too bearish. But again, at a PE of 11, it is trading pretty cheaply. Over the last year, shares are up 17.8%, but that is trailing the S&P 500. So we do have a bit of a trail with this one. Dividend 2.6%. And, not outperforming the S&P 500 is pretty common for a lot of value stocks, right? There is a reason they're being ignored, and the street even is doing better than what the ignored stock is doing. So that's Molson Coors, ticker TAP. And then the final stock, and this is the one that I had a little bit of a snafu on, was going to be Carol's Restaurants. And the ticker there is TAST. And in case you're not familiar with Carol's, it is the largest Burger King franchisee in the U.S. with 1,000 Burger Kings in 23 states and then 60 Popeyes in six states. But I forgot until I was kind of poking around that the Restaurant Brand Groups is acquiring them. Supposed to close in the second quarter here of 2024. So in April, May, June sometime, it should be closing. And so I had a kind of redo it because they were cheap with a PE of 14.8 and price of sales of 0.28, but they're being bought out at $9.55 per share in an all cash deal. And that's basically right where the shares are trading right now, because they would be, because that's what you're going to get. So Restaurant Brand Groups, I went to go look at them. Are they cheap? They did not make the screen, but maybe they just have the wrong Zacks rank, which they do. They are a Zacks number 3 rank, which is the hold. Nothing wrong with the holds. And Restaurant Brand Groups, trades in the U.S. with the ticker QSR for them. They're not, I think it said in one of the press releases, the ticker was RBI, but that's in Canada. So in the U.S., it's QSR. And they own Burger King U.S., as well as Tim Hortons Canada. So that's the coffee chain up there that people love. So if you want to own Tim Hortons and Burger King, plus you're going to get 60 Popeyes in 6 states when they acquire Carol's, then Restaurant Brand Groups is where you should be. Now, I also took a look at their recent earnings just to kind of see what was going on with them. And, the restaurants are still really hot, even with inflationary pressures, having to raise prices on the menu and, higher labor costs and in some cases food costs. The restaurants people are still going. The same with apparel, where now the consumer is still buying, and they are still going even with the higher menu prices. So Tim Hortons Canada, the comparable sales, which is the key metric you look for in restaurants, it was up 8%. So that's year over year comparables from this same restaurant. Pretty strong. Anything, above 5 is pretty much crushing it for most restaurant chains, because it's difficult to grow comparable sales year over year. Now, some of it might be from menu price increase, volumes, foot traffic is increasing. And in addition to some menu increases, is getting you that good same store sales. Burger King US was also up 6% on the same store sales, or comparable sales as they like to call it. So that's also a good number. And we've seen this with other restaurant chains that have reported as well, including like the kings of the restaurants like Chipotle. But I can't remember a time when even like the burger chains were doing it too. So are we all going to Burger King? I'm a big fan of the Burger King. And sadly, because I live in Chicago, which is the home of McDonald's, basically in Chicago, its headquarters is here. We don't have many Burger Kings. They are there, but there's still a lot more McDonald's. And so I have to go on like a journey to go to my Burger King. I hope they're listening. They did just close another one, actually, not that far from Wrigley Field, actually. There's that one's going away too. So it's a nice journey though to go to the Burger King. But But what is it looking like for the cheapness of this stock for restaurant brand groups? Well, it's unfortunately not as cheap as Carol's Restaurant. So there's a reason they're getting Carol's Restaurant and they're getting it cheap. So good for them. But PE of restaurant brand groups is 23.3. Price to sales is 3.5. So pretty pricey compared to what the screen was looking for. Not a value stock under PE or price to sales metrics. But if you do compare it with some of the other big restaurant chains, it may not look as expensive as some of these other ones are, because I know Chipotle is trading at like 51 times. I'm looking at McDonald's. Well, it's kind of in line with McDonald's. It's at 23.6 times, and they're at 23.3. So nothing real cheap in restaurant land, I'm afraid, on a PE basis. You might be able to get lucky and find something on price to sales or, a PEG ratio maybe. I'm looking at Potbelly's too. See, even Potbelly's, which is reporting earnings this week as well, it has a PE of 61. So that used to be cheap, but it's had a huge rally as well, all these stocks. So what does this say about the economy, actually, that a lot of these consumer-centric names, are they all consumer? Well, I guess Sunoco is consumer too, because they're distributing the fuel. So basically all of the stocks I covered today are really consumer-focused, and they are cheap. So there is a reason that they're cheap in these categories that are impacted by consumers. But the fact that they've all mostly rallied here suggests to me that things aren't quite as bad as everybody anticipated maybe a year ago with some of these stocks, and that they would really see a pullback by the consumer in spending. And we're not really seeing the pullback by consumers in spending. So now the stock market is kind of playing catch up. And that's why we have these big gains. So kind of looking, I did want to see what this restaurant brand is looking like, because I know Chipotle is trading at new highs, and then Potbelly's has had quite a run. McDonald's was at new highs not that long ago. And restaurant brand groups, it is like right there at its 5-year high is what it looks like. So it's been a long journey back from the collapse during the pandemic for this one, but it has now busted out to a new 5-year high even on this one. So restaurants are hot. If you can get one cheap, you might want to think about it. So let me recap the stocks we talked about again on this episode. So there's American Eagle, which is the teen and 20-somethings, but some others are also buying it too. Clothing and accessory retailer, men's and women's. Ticker AEO is the ticker there. Then we had the cabinet maker, American Woodmark, ticker AMWD. AMWD. Then we had Sunoco. They distribute the fuel to the gas stations, basically. Ticker SUN, and the big dividend yielding 5.4%. Then we had Molson Coors, ticker TAP. That's easy to remember. TAP, also paying a nice dividend at 2.6%. Then we tried for Carol's Restaurant, ticker TAST, but they are being acquired, and it's going to happen soon in the next couple of months. So they're being acquired by Restaurant Brand Groups, the owner of Burger King and Tim Hortons, ticker QSR. So as always, I try to bring you as many value stocks as I can, even in this time of a big rally. And there are some, as I just mentioned, and these stocks have mostly rallied as well. Big rallies over the last year. So, but you can still get them cheap on a PE and price to sales ratio. And there are others like them out there, because this is just 5 out of 37 companies that were in this screen with the highly coveted Zacks #1 rank of strong buy. So be sure to be doing your research out there on all of these stocks, and because you might end up like I did, like thinking, oh, Carol's Restaurants, yeah, I know them, they own the Burger King, and then going, whoops, when you go to look in and see, oh yeah, they're being acquired, and I didn't realize. So keep that in mind. You don't want to just buy a stock and then wonder, why is it not going up from 950? Why is it doing nothing all this time? So keep those things in mind. Do your research. Go beyond the Zacks rank, because the Zacks rank doesn't always tell the full story, obviously. And you have to dig a little bit deeper. Listen in on those conference calls. Get as much information as you can, maybe from analyst notes. Do your own research. If you are going to buy Burger King, do you go there? Have you tried it? Do you know what its new products are like and what's going on at the restaurants? I have had friends who have bought some restaurant stocks and they have never been to that particular restaurant. So, it's fun to buy what you know and what you like. So keep that in mind too. Other people may not like it as much as you do, but it does keep you interested in the company. If you wear the clothes, if you shop at the place, if you get the gas from the convenience station, the store that they're delivering it to. I don't know. There's a lot of ways you can be involved in the companies that you own. And remember, value investors, we like to be long-term investors, like Warren Buffett at Berkshire Hathaway. We want to own for a couple of years. So you might want to like what you own if you're going to own it all that time, right? So keep that in mind and be sure to subscribe to get all of our podcasts here. I know many of you are subscribing and you're subscribing on YouTube to the Zacks podcast page over there, but you can also get us on Apple. We're on Spotify. We're on Amazon Music. We're on a bunch of other platforms as well, but be sure to get us somewhere, and I'll see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.